It's December 2025, and if you're a business owner staring at your profit and loss statement thinking, wow, I'm about to hand over Sam a check that could have bought a Tesla, don't panic yet. Because I'm going to show you 7 legitimate tax strategies you can still implement before the ball drops on New Year's Eve. And unlike in New Year's Eve resolutions, these might actually stick. So here's the thing nobody tells you about business taxes. The game is played in the fourth quarter. Most business owners spend January through November building their business, and then December 15th hits, and then suddenly they realize they're looking at a massive tax bill with exactly 2 weeks to do something about it. Well, that's like trying to lose 30 pounds between Christmas and New Year's. Theoretically, yeah, I guess it's possible, but you're going to need a strategy that actually works. I'm Josh Bennett. I've spent 15 years helping business owners navigate this exact situation. And look, I'm not going to promise you some magical loophole that the IRS doesn't want you to know about, because that's usually a great way to end up explaining yourself during an audit. What I am going to show you are 7 completely legitimate IRS-approved strategies that successful business owners use to significantly reduce their tax liability, even when they're down the wire. Some of these could save you 5 figures. One of them potentially could save you 6 figures in your business if it's doing well enough. And yes, before you even ask, everything we're discussing assumes you're running a legitimate business, and if your business is losing money every year while you're funding your hobby, well, we need to have a different conversation. Anyways, strategy number 1, Section 179 and bonus depreciation, or as I call it, turning this year's profits into next year's equipment. So here's what most people don't understand about business equipment purchases. The One Big Beautiful Bill Act signed this past July doubled the Section 179 deduction for 2025. You can now deduct up to $2.5 million in qualified equipment purchases in the year that you buy it. Not spread out over several years like traditional depreciation. That's double what was last year, and bonus depreciation is back to 100% for qualifying property. This is huge. Now there's a catch. The equipment has to be purchased and placed in service by December 31st. So if you've been thinking about upgrading your computers, buying that new company vehicle, investing in machinery or furniture or equipment, this is your window. Let me give you a real example. Say you're a self-employed consultant and your business made $300,000 in profit this year between federal income tax and self-employment tax. You're looking at a combined tax bill of $98,000. Ouch. But here's where it gets interesting. If you purchase $80,000 in qualified equipment before December 31st, computers, office furniture, machinery, whatever your business legitimately needs, your tax bill drops to about $68,000. You just saved over $30,000 in taxes with an $80,000 equipment purchase. That's nearly a 38% immediate return through tax savings alone, before equipment even generates a single dollar of revenue for you. And here's the catch too. You can also finance it. You don't have to necessarily use your cash right away. You can finance it, get it in before December 31st, still get the tax benefits, and just pay it off later. Now, here's the insider tip that saves people thousands. Placed in service doesn't mean fully installed or even used yet. For most equipment, it just means it's delivered and ready to use. So that new server, as long as it's delivered and plugged in by December 31st, you're good. You don't need to have it transferred a single file. Though I recommend you do, because last minute equipment purchases without testing them is its own kind of January headache. But quick sidebar. So this happened to a real client. He bought a luxury car for $60,000 or $65,000 on December 30th, specifically for the tax deduction. And he was excited about writing off his BMW, except forgot one tiny detail. For most passenger vehicles under 6,000 pounds, the deduction is capped at $31,300 for 2025. He thought he'd deduct the full $65,000. His actual deduction, $31,300. His face when I told him this on January 2nd, priceless. His language, not suitable for YouTube. The lesson, heavy SUVs and trucks over 6,000 pounds qualify for the full deduction. Luxury sedans, lighter vehicles don't. So know the rules before you buy the toys. Or better yet, call your CPA before you're signing the paperwork. Strategy number 2. Maxing out retirement contributions. And this is where you can really move the needle on both taxes and your future. So here's something that surprises people. Unlike personal IRAs that have an April 15th deadline, business retirement accounts have different rules. So SEP IRAs can be set up by December 31st and funded all the way until your tax filing deadline, even with extensions. That gives you until October 15th of next year But if you really want to maximize the strategy, consider a solo 401k. So for 2025, if you're 50 or older, you can contribute up to $77,500. If you're under 50, it's $70,000. Let me show you exactly what that means for your wallet. So same example, $300,000 in business profits, looking at $98,000 in combined taxes. You max out a solo 401k at $70,000. Your new tax bill, $69,000. You just saved nearly $29,000 in taxes while putting $70,000 into your retirement account. So think about that math for a second. You contributed $70,000 to your retirement, but your actual out-of-pocket costs after taxes was only about $41,000. That's over a 40% discount on retirement savings, courtesy of the tax code. So the IRS basically just funded more than 40% of your retirement contribution, and that's not a loophole. That's literally how the system is designed to work. Now, the catch with solo 401ks, they generally need to be established by December 31st. The employee deferral portion needs to be made by December 31st too. The employer contribution portion, you have until the filing deadline. But that employee piece, tick-tock. SEP IRAs are more forgiving on timing, but they have slightly less favorable contribution rules. For some situations, your CPA can help you figure out which is better for you, but either way, if you don't have a business retirement account set up yet, this week is the time. Strategy number 3, accelerating deductible expenses, or what I call the art of strategic spending. This one's straightforward, but incredibly powerful. So any ordinary or necessary business expenses you're planning for early 2026, if you can legitimately prepay it by December 31st, you can deduct it this year. So this includes annual software subscriptions you're already using, professional liability insurance for next year, prepaid rent, or lease payments, or for 2026, marketing campaigns launching in January, professional development in training you're planning to do, consulting fees for projects starting early next year. The key rule is that the IRS calls the 12-month rule. You can prepay up to 12-month expenses as long as the benefit doesn't extend beyond the end of next tax year. So translation, you can prepay January through December 2026 expenses in December 2025. However, you cannot prepay 2027 expenses and deduct them now. So the real world impact, let's say you typically spend $30,000 per year on software, insurance, and professional services. You prepay all of it in December instead of paying monthly through the next year. At your tax rate, that $30,000 in prepaid expenses saves you about $9,000 in taxes. Again, that's real money staying in your account instead of going to the government. Now, the massive caveat here, and I cannot stress this enough, do not prepay expenses just for the tax deduction. If it's going to hurt your cash flow, saving $9,000 in taxes isn't worth it. If you can't make payroll in February, this strategy works beautifully when you got the cash or are going to pay these expenses anyways. It's terrible if you're draining your emergency fund to do it. Strategy number 4, strategic income deferral. And this is a mirror image of accelerating expenses. If you're a cash basis taxpayer, which most small businesses are, income isn't taxable until you actually receive it. So if you've got invoices you could send in December, but you wait until January to send them, that income doesn't hit your taxes until your 2025 taxes. Now, I know what you're thinking. Don't I eventually have to pay taxes on it anyways? Absolutely. But there are 3 huge reasons why deferral can make sense. First, time value of money. If you defer $18,000 in taxes from April 2026 to April 2027, and you earn, say, 5% on that money, that's $900 of free money just from timing. Second, tax bracket arbitrage. If you expect to be in a lower tax bracket next year, maybe you're taking time off, transitioning to retirement, or planning a lower income year, deferring income means paying taxes on it at a lower rate. Third, cash flow. Sometimes having more cash in January to invest in growth opportunities is more valuable than having it in December. Here's a specific example. If you defer $50,000 in December billings to January, at your current income level, that $50,000 would be taxed at about 36%. That's $18,000 you're not paying in April 2026. Now, let's say next year you're planning to take 3 months off, dropping your income significantly when that $50,000 comes in. Portions will get taxed at 24% instead of 32%. That's a permanent tax savings of nearly $4,000. Just again, from timing the income correctly. But here's the flip side. If next year you're expecting a massive income spike, this strategy obviously backfires. You'd be pushing income from a lower tax bracket year to a higher tax bracket year, which is not smart. So the decision is simple. Similar to lower income next year, defer. Much higher income next year, take it now and pay the tax. Strategy number 5, S Corp salary optimization. And this is where sophisticated business owners have serious money year after year. If you're running an S corporation, you've got a unique opportunity. The IRS requires you to pay yourself a reasonable salary, subject to payroll taxes, that's 15.3% total, but profits beyond your salary come out as distributions, which are only subject to income tax, not payroll taxes. So here's a concrete example. Your S Corp made $300,000 in profit. You've been paying yourself a $200,000 salary, leaving $100,000 in distributions. Your payroll taxes are about $27,600. But research shows a reasonable salary for your role is actually maybe closer to $120,000. If you restructure to pay yourself $120,000 in salary and take $180,000 in distributions, your payroll taxes drop $18,400. So you just save $9,200 per year. And here's the beautiful part. Your income taxes stay exactly the same because you're still taxed on the full $300,000 either way. The savings is pure payroll tax elimination on that $80,000 difference. Now the critical question, what's reasonable? So the IRS looks at industry standards like your experience, time devoted to the business, what comparable employees earn in similar roles for the business. For the business owners, reasonable salary ranges from, say, 30 to 50% of profits, but it's heavily dependent on your industry and role. Set it too low when you're inviting an audit. Set it too high, and you're leaving thousands of dollars on the table each year. So the sweet spot actually requires research, using the Bureau of Labor Statistics data, industry salary surveys, and professional gains. You can't change 2025 retroactively, but you can absolutely optimize your 2026 structure. So work with a CPA, get this right. It's one of the highest ROI planning conversations you can have. So strategy number 6, maximize your qualified business income deduction. And here's some great news. The QBI deduction was supposed to expire at the end of 2025, but the One Big Beautiful Bill Act, which I still can't get over the name, made it permanent. That's right. So this is 20% deduction for pass-through business owners is now a permanent part of the tax code. And they made it even better. They expanded their phase-in ranges, so basically more people qualify. And for 2025, if you're a single filer with taxable income under $197,300, you generally claim the full 20% deduction. If you're in a specified service business, consulting, law, medicine, accounting, the deduction phases out completely by $240,300. Here's why this matters. Let's say you're a consultant with $300,000 in profit after deductions. Your taxable income is $285,000. Well, above that phase out threshold, the QBI deduction is 0. You get nothing. But if you implement the tax strategy you've already covered, say max out solo 401k at $70,000, buy-in by $28,000 in equipment, you drop your taxable income to $187,000. Now you're under that threshold and you qualify for the full 20% deduction. On $187,000 in income or business income, that's $37,400 in deduction, worth about $8,900 in tax savings. So again, the strategy is crystal clear. If you're anywhere near those thresholds, use every legitimate tool to get out of them. Max out retirement, buy needed equipment, prepay expenses, defer income if appropriate. And now that QBI deduction is permanent. So this isn't just a one-year strategy. This is a tax plan that you can count on for years to come. Strategy number 7, the Augusta rule. So this is one of the most underutilized strategies in the entire tax code. And here's how it works. So you basically rent your home to your business for up to 14 days per year. And that is rental income is completely tax-free to you personally, 0 taxes. Meanwhile, your business deducts it as a legitimate expense. So this is perfect for board meetings, strategic planning, client presentations, entertainment, team training, development sessions, and just company events and holiday parties. So the requirements are simple, but important. Legitimate business purposes with documentation and reasonable rates comparable to commercial event spaces or meeting venues in your area. So let's say you research a commercial meeting space in your area, find that they rent for $600, $800 per day. You can charge your business $700 per day for 14 qualifying business events throughout the year. That's $9,800. So your business deducts $9,800, saving you about $3,500 in taxes. And depending on your bracket, that $9,800 you personally received, again, completely tax-free. No income tax, no payroll tax, nothing. So a few ways to extract money from your business with zero tax consequences. But here's what makes or breaks the strategy. Documentation. So you need a rental agreement. You need a written rental agreement, documentation of business purpose for each day, attendance records or agendas. So basic proof of a comparable rental rates, evidence of the events actually occurred. The IRS looks closely at this one, so make it bulletproof. Your board meeting can't just be you working from home in your pajamas. It needs to be a legitimate business event you can defend. Done right, it's nearly $10,000 in tax-free money. Done wrong, it's a disallowed deduction and potential penalties. So, all right, we've covered 7 potentially powerful strategies. Let me be honest with you. Not every strategy applies to every business, but if you're sitting on significant profit and you implement even 3 of these strategies, you could realistically save $20,000 to $50,000 or more in taxes. So here's exactly what you need to do in the next 10 days. Today, pull out your current year-end profit projection, and you need to know exactly where you stand, not where you think you stand. And then this week, schedule an emergency call with your CPA, not next week, not after Christmas, this week. These strategies require planning if you're frankly running out of time. So by December 20th, decide what strategies you're implementing, run them for exact numbers for your situation with your tax advisor. By December 31st, execute everything. Make the equipment purchases, fund the retirement accounts, send the rental agreements, prepay the expenses. After the midnight on the 31st, these opportunities are gone for 2025, at least most of them. So if this saved you tens, potentially thousands of dollars in taxes, hit that subscribe button and turn on notifications. I publish tax strategy content every week. And this could keep more money in your pocket. So it's worth a follow, and drop a comment with which strategy you're using and any questions that you have. And again, this is for educational content only. This is not personalized tax advice. Your situation is unique. Work with a qualified tax professional before implementing anything. Don't be the person who costs themselves money trying to save money. But until next time, cheers.